Hello folks, Steve Lentz here with Discover Options. Welcome to this presentation of 3 different S&P 500 market timing reports for advanced options traders. This will be for Friday, July 13th, getting ready for Monday, the 16th. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. All 3 reports pertain to the current market condition as displayed in this chart right here. We look at market condition in terms of 3 different dimensions: price action, trend, and the stochastic situation. In terms of price action, Friday was an upswing bar that followed Thursday's upswing bar, where we had a higher high and higher low. Okay, so 2 consecutive upswings occurring in the context of our trend, which is bullish. We are above the 50-day simple moving average. And in terms of the stochastic situation, we are between 60 and 100, and the stochastic is actually just barely beneath its 3-day simple moving average, or %D. All 3 of those dimensions make for a market condition that has occurred roughly, let me go to the next slide, 82 times or so. 82 times. And so that current market condition is what we'll apply to all 3 reports. Let's go to the Condor butterfly timing report to kick things off. So we'll start here with the narrative. So since January of 2000, we've had roughly 4,664 daily closes of the S&P 500. Now, of those, 65% have been favorable bars for selling option premium, where the actual 21-bar subsequent movement was less than the SIBO's skew-adjusted implied movement. Okay, so benchmark is at 65%. You could flip a coin several times. 65% of the time, you'll end up on a bar that turns out to be favorable for doing condors or butterflies. So that's the benchmark. Now, as I mentioned, we've had 82 occurrences of our current market condition, and of those, 75.6% of the bars have been similarly favorable for option premium selling. That's a bit higher than the benchmark of 65, so we have then a theoretical selling edge of 10.6%. That's pretty darn good. So statistically, it's more likely than usual that our current market condition will end up being a favorable one for market neutral option premium selling using strategies like condors or butterflies. Okay, so that's that report. Let's go to the next one. This is the bull put spread timing report. This is for those that like to sell puts either through naked put selling, bull put spreads, or even hedged bull put spreads. And this presupposes that you'll sell put premium a standard deviation out 30 days, out of the money, and then 30 days out in terms of time. So here we go. As I mentioned, we've had 4,664 closes of the SPX. Of those, 83% turned out to have been favorable bars for selling put premium in that fashion, where the actual 21-bar downside movement was less than what was being implied by the SIBO's skew-adjusted VIX to the downside. Okay, so 83% of the time, if we flipped a coin several times, 83% of the time on average, we would end up on a bar that was favorable for selling puts, where the market never moved down that far over the course of those 30 days. Now, also during that time, since Jan of 2000, our current market condition has occurred 82 times. Of those 82 occurrences, 86.5% of the bars were similarly favorable for put option premium selling. So that implies an edge of 3.5% there. Pretty good. Statistically, it's more likely than usual that our current market condition will end up being a favorable one for selling out of the money put premium in that fashion. Okay, so those are those 2 reports. Let's finally go to the market likelihood report. This is where we look at the rate of change and the actual volatility of the market. And we look at our current market condition just to see if there's any directional bias or any volatility clues that we could gather. So let's begin with rate of change. Grab the little thing here. So we've had 4,664 closes since Jan of 2000. Our 5-day rate of change, meaning that you would take a close and then the close 5 bars later, okay, on average, the 5-day rate of change is at 0.1%, a tenth of a percent to the upside. I mean, since Jan of 2000, we've had a bullish market all in all. We've had certainly bearish seasons. All in all, the market's gone up quite a bit. On average, a 5-day rate of change of 0.1%. The 2-week rate of change is at 0.2%, a fifth of a percent. The 3-week rate of change, 15 bars, is at 0.29%. Now that's the benchmark. Okay, let's go to the 82 occurrences of our current market condition. The 5-day rate of change typically is at 0.02% to the downside, believe it or not. Okay, the 2-week is at 0.41 to the upside. Now what's the difference then between that and our benchmark? Well, on the 5-day rate of change, it's at 0.12% to the downside. That z-score is only a 14% of 1 standard deviation to the downside. Not very much. Not very much. The 2-week difference is at 0.21 of a percent. That works out to a z-score of, gosh, not even a 0.25% to the upside. And the 3-week difference is just 8% of a standard deviation to the upside. Nothing to write home about. Nothing significant. Ideally, we want z-scores at half a standard deviation, a full standard deviation up or down. Here, in fact, for this whole breakdown is pretty much flat. Now, there's one here at about 1 standard deviation. Let's get to that now. So we break out these 82 in terms of those times where the market exceeded the high from Friday in this case. So if on Monday the market goes up above Friday's high, okay, that occurred 32 times in the past. All 3 of the rates of change were to the upside by a small difference here, working out to z-scores of 5% of a standard deviation, almost half a standard deviation in terms of the 2 and 3 weeks. So keep that in mind. If the market does go up above Friday's high on Monday, if on Monday it goes up above Friday's high, you have a 2 and 3 week history here of a half a standard deviation to the upside rate of change. A definite bullish bias to the upside over the next 2 and 3 weeks if history plays itself out. There's no guarantees, of course. We're just reporting what the statistics show, since Jan of 2000 as it relates to this market condition. If the market descends below Friday's low, okay, you have z-scores again that are, gosh, not even a fifth of a standard deviation in either direction there. Pretty flat, nothing to write home about. Now, let's talk about volatility, because the benchmark volatility in the market is between 15 and 16%. Okay, our current market condition typically results in realized volatility of basically between just roughly 10 to 11%. Definitely less volatility than the benchmark. Okay, now come down here to the VIX. The VIX is at 12.18, which is a bit higher than what our realized volatilities are for our current market condition, and hence that's why we have the edge, the perceived edge in selling premium both neutrally and from a bull-put spread perspective. Okay, very interesting. So, and then you can see how it breaks out similar volatility levels. To the downside, it's a little bit higher, but still underneath what the VIX is currently at 12.18. All right, I hope this information has been helpful to you. I'm Steve Lenz with Discover Options. Have a great week trading. Take care. Bye-bye.